I was standing at a coffee shop this morning waiting for my latte, and I saw a guy in front of me just glued to his phone. And he wasn't texting or on social media. He was watching one of those candlestick charts on a trading app, just watching these little green and red bars flicker up and down. And he looked stressed.
It's the modern condition, isn't it? We've sort of gamified the global financial system to the point where it fits in your pocket and gives you a dopamine hit or a cortisol hit every 3 seconds.
Exactly. We are absolutely obsessed with speed. High-frequency trading algorithms that execute orders in nanoseconds.
Right.
You have day traders trying to scalp a few cents off a stock movement before their lunch break. It feels like if you aren't moving at the speed of light, you're losing.
Well, today I think we're going to pull the emergency brake on all of that.
I hope so. We are going to look at a strategy that is arguably the complete antithesis of that entire culture.
It really is.
We are unpacking a concept that feels almost, counterintuitive in 2026. It's basically the art of doing absolutely nothing.
Well, I'd push back slightly on the word nothing. It's the art of doing nothing physically in terms of, clicking buttons, but doing something very, very difficult psychologically.
That's a fair point. We are diving deep into buy and hold.
Yeah.
And before you roll your eyes and think, okay, I know this, just buy an index fund and forget about it. Stick with us.
Please do.
Because when you actually dig into the source material, and we have a huge stack today, ranging from Federal Reserve data to deep academic theory, this isn't just about laziness. It's a sophisticated financial framework that is technically known as position trading.
That's a formal term, yes,
Yep.
Position trading. And the mission for this deep dive is really to answer one specific question.
What's that?
Why is this passive style, where you essentially stand still like a statue, often so much more profitable than the active style where you're sweating over monitors trying to beat the market?
It's the paradox of effort. It's so strange. Usually in life, working harder gets you more results. If you dig a ditch for 10 hours, you get a bigger ditch than if you dig for one. But in investing, working harder, trading more, might actually just make you broke.
That is exactly what the data suggests. The correlation between activity and profitability is very often negative. It's a shocking finding, but it's true.
So we've got the philosophy of billionaires, we've got the cold hard math on taxes, and we've got some fascinating insights on cognitive biases.
It's a great mix.
Let's get into it. What exactly is this beast we are dealing with?
Okay, let's strip away the jargon for a second. When we say buy and hold or position trading, we are talking about a specific mindset. The source material defines it as an investment strategy where an investor buys assets. And this is a key distinction. They can be financial assets like stocks, or they can be non-financial assets like real estate.
Right. So this isn't just for the stock market. You could position trade, a plot of land, or a piece of art.
Exactly. You buy it with the intention of holding it for the long term. And the primary goal, the only real goal, is realizing price appreciation.
But there's a catch.
There is. Here's the caveat in the definition that I think does all the heavy lifting. It says, you do this despite volatility.
That is the position trader's litmus test right there.
Yeah.
Volatility is, I guess, the price of admission to the whole show.
It is. And can we define volatility for a second? Because I think people hear that word and they just think danger or risk or I'm losing money.
Please do. It gets thrown around a lot.
In finance, volatility usually refers to how much the price of something swings around its average. We use standard deviation to measure it if you want to get technical.
So give me an example. Low versus high.
Okay. If a stock goes from $100 to $105, then down to $102, that's low volatility. It's a gentle ride.
Like a lazy river.
A lazy river, exactly. But if it goes from $100 to $150 and then crashes down to $50 in a month, that's high volatility.
That's the roller coaster that makes you want to throw up your lunch.
Exactly. Now, the active trader, or just the average person, looks at that drop to $50 and they panic. They sell to stop the bleeding. The position trader looks at that wild swing that dropped to $50 and does nothing.
See, that's where that lazy label comes from, isn't it?
Yeah.
If the house is on fire, you run. If your stock portfolio is crashing and you do nothing, are you being disciplined or are you just asleep at the wheel?
That's the common misconception, and it's a great question. The strategy is classified as passive management, yes, but our source material is very clear. This is not ignore and forget.
It's not.
No. It requires a profound level of confidence. You are holding because you have a fundamental thesis, a core belief, that the value of what you own will be higher in 10 or 20 years.
So it's an active choice to be passive.
Yeah.
You aren't paralyzed by fear. You are, I guess, frozen by conviction.
Exactly. It's like being a captain of a ship in a storm. You aren't spinning the wheel wildly trying to dodge every wave. You're holding the course because you know where the port is.
Okay, so to do that, what kind of person do you have to be? The source talks about the mindset required.
Yes, and this is where it gets tough for most people. The source says you have to battle some very specific inner demons. First, you cannot be prone to emotional decision-making.
Which is asking a lot of the human brain. We're wired to flee from pain, and a big red number on a screen feels like pain.
It absolutely does. Neuroscience studies show that financial loss registers in the brain very similarly to actual physical pain. So you have to first understand your own risk aversion.
Know thyself.
Know thyself. But the biggest enemy, the one mentioned specifically in our source stack, is recency bias.
I love this concept. Let's break this down, because I think everyone suffers from this, whether they invest or not.
For sure. Recency bias is this cognitive glitch where our brains assume the future will look exactly like the immediate past. It's a mental shortcut our brains take to predict what's coming next. It's efficient, but often wrong.
So if the market has been on a tear, going up for 6 months straight,
You assume it's a golden age that will last forever. You feel rich, you feel smart, and your brain just extrapolates that line going up and to the right indefinitely.
and conversely, if the market dropped 5% yesterday,
You assume it's going to zero tomorrow. You extrapolate that immediate pain into the infinite future.
that feels very familiar.
It's human nature. A true position trader has to surgically remove that part of their brain. They do not judge the long-term future based on the last 5 minutes of data. They do not sell just because of a temporary decline in value.
It sounds almost stoic. Like you said, it's not about being lazy. It's about being incredibly disciplined, like Marcus Aurelius managing a hedge fund or something.
It is stoicism applied to finance. It's all about separating the signal, which is the long-term value creation of a business or an economy, from the noise, which is the daily meaningless price fluctuation.
Okay, so that's the definition. It's a long-term marriage to your assets through sickness and in health. But let's look at the resume. Who actually vouches for this? Because if it's just academic theorists in an ivory tower, I'm a little skeptical.
And you should be. But the source lists a murderer's row of investors here. It's not theory, it's practice.
Lay the names on me.
It's the financial equivalent of Mount Rushmore. We are talking Warren Buffett,
Obviously.
Jack Bogle, the founder of Vanguard, Burton Malkiel, who wrote A Random Walk Down Wall Street,
A classic.
John Templeton, Peter Lynch, Benjamin Graham. I mean, the list goes on, right?
I want to pause on that list because those aren't just rich guys. They represent totally different, sometimes opposing philosophies. That's what strikes me as odd.
Right. That's the key insight here. This is not a niche belief system.
You have Warren Buffett and Benjamin Graham, the kings of value investing. They spend their lives picking individual stocks. They analyze balance sheets. They interview management. They are actively looking for diamonds in the rough.
The ultimate active managers in terms of research.
Then you have Jack Bogle, the father of the index fund,
Yeah.
who basically said, don't even try to pick stocks. Just buy the whole market and go on vacation.
Right. By the haystack.
These guys shouldn't agree on anything. It's like a cat and a dog agreeing on what to have for dinner.
But they do. They disagree on what to buy, but they agree entirely on how to hold it once you've bought it.
Why? What is the common denominator that unites a deep value stock picker like Graham with a broad market indexer like Bogle?
It's the macro justification. The source points this out very clearly. They all believe that in the long run, there is an extremely high correlation between the stock market and overall economic growth.
Betting on civilization, or betting on America, as Buffett likes to say.
Essentially, yes. If you believe that human beings will continue to innovate, that populations will generally grow, that productivity will increase over time, then you believe the economy will grow. And if the economy grows, corporate profits grow. And if corporate profits grow, then over the long term, stock prices have to rise to reflect that. It's just math.
So if you trade in and out, jumping out of the market because you're scared of a recession or some headline, you are effectively betting against human progress.
Or at least you're risking missing the ride when it resumes. The stock market is the engine of the economy. If you unplug the engine every time it sputters or makes a funny noise, you will never get anywhere.
It's interesting because it reframes investing from Gambling on a ticker symbol
Yeah.
to participating in capitalism.
That's it. You are an owner, not a gambler. Owners don't sell the business just because it had a bad month. If you owned a local pizza shop and you had a slow Tuesday, you wouldn't put a for sale sign on the door on Wednesday morning.
No, you'd wait for Friday night when everyone wants pizza.
Exactly. Buy and hold is about treating stocks like what they actually are. Fractional ownership of real businesses, not like chips in a casino.
Okay, I want to get a little nerdy here because the source material dives into the theory behind this. And there's a conflict in the logic that I'm struggling to wrap my head around.
Let's do it.
We talked about Buffett, and the source also brings up the efficient market hypothesis, or EMH.
Right. This is the great theoretical battleground of modern finance.
So walk me through the efficient market hypothesis first. For the listener who maybe skipped Econ 101, what is the elevator pitch?
The EMH, in its simplest form, basically states that the market is a giant, hyper-efficient information processing machine. It takes all known news, all earnings reports, all fears, hopes, and data, and incorporates it into the price of a stock instantly.
So because of that, every stock is always fairly valued.
That's the conclusion, yes. There are no real bargains to be found. If a stock is trading at $50, the EMH says it's because it's worth exactly $50 given everything we know right now.
So there's no $100 bill lying on the sidewalk, because in a world with millions of investors, someone else would have already picked it up.
That's the classic analogy, yes.
Okay, so if you believe in the EMH, you buy and hold, because active trading is pointless. You can't beat the market because the market is always right, so you just join it.
Correct. If the price is always right, trying to find a wrong price is a fool's errand. You just buy the whole market and hold it forever. In fact, the extreme EMH advocates say you should never sell a security unless you specifically need the liquidity, like you need to buy groceries or a house.
But here is the paradox. The Buffett paradox, as the source calls it. Warren Buffett is the poster child for buy and hold. His favorite holding period is forever. But he's famously said on many occasions that the efficient market hypothesis is complete nonsense.
He has. He's been very vocal about it. He has a great quote where he essentially says that if the markets were efficient, he'd be a beggar on the street with a tin cup.
So wait a second. Buffett thinks the market is inefficient, that it makes huge emotional mistakes.
Yes.
But the EMH says the market is perfect and never makes mistakes. How do they both end up advocating for the exact same strategy?
This is the nuance that I think most people miss, and it's a fantastic point. They arrive at the same destination from two completely different starting points.
Okay, walk me through it.
Buffett buys stocks because he thinks the market is inefficient. His entire fortune was built by finding a wonderful company that is intrinsically worth, say, $100 a share, but is selling for $50 because the market is panicking about a short-term problem or just ignoring it.
So he exploits the market's mistake.
He finds and exploits the mistake. But, and this is the crucial buy and hold part, he knows the market will eventually fix that mistake. The market will come to its senses, but it might not happen tomorrow. It might take 5 years or 10 years. So he buys the undervalued asset and just holds it patiently until the market price catches up to the business's true value.
Okay, I think I get it. So the EMH believer says, buy and hold because the price is always right.
Correct.
And Buffett says, buy and hold because the price was wrong. When I bought it, I got it cheap, and now I'm just waiting for all of you to figure out that I was right.
Precisely. One path is based on humility, the idea that I know nothing, the market knows everything. The other path is based on a sort of intellectual arrogance. I know more than the market does about this specific company. But both paths lead to the exact same behavior: inactivity, holding.
It really shows the robustness of the strategy then. It works whether you think you're a genius investor or whether you think you're perfectly average.
As long as you have the patience. That is the one non-negotiable ingredient, no matter which philosophy you follow.
All right, enough of the high-minded philosophy. Let's talk about something everyone understands. The wallet. Because even if you don't care about market theory or Buffett, there's a very boring, very mathematical reason why buy and hold almost always wins.
The friction argument, yes. This is where the debate often ends for practical people.
Friction, I like that word. It implies resistance, something slowing you down.
And that's exactly what it is. Every time you move your money, every time you buy or sell, someone takes a slice of it.
The source mentions commissions.
Right, commissions. Now, I know what people are thinking, well, I used Robinhood or some other app. Trading is free now.
That's the marketing slogan, yeah. Zero commission trading.
But it's not really free. There are hidden costs. There's something called payment for order flow, where your broker sells your order to a high-frequency trading firm to execute. There are bid-ask spreads. That's the tiny difference between the price you can buy at and the price you can sell at. We call this slippage.
So you're always leaking a little bit of oil every time you shift gears.
Exactly. And if you're shifting gears 100 times a day, you run out of oil pretty fast. The buy and hold investor, meanwhile, just sits in one gear for 20 years. They minimize all those little transaction costs.
Those are small leaks. Let's talk about the big one.
The shark in the water.
It's not your broker. It's the IRS.
The tax man. This is where the math becomes absolutely brutal for active traders.
Break down the difference for us. Short-term versus long-term capital gains.
Okay. Generally speaking, in the U.S. and many other tax jurisdictions, the tax code is written to reward patience. If you buy an asset and then sell it for a profit within 1 year, that profit is considered a short-term capital gain.
And that's taxed how?
That is usually taxed as ordinary income.
So it's taxed at the same high rate as my salary.
Exactly. So if you're a high earner, that could be 35%, 37%, sometimes more, of your hard-won profit going straight to the government.
Ouch. That stings.
But if you hold that same asset for over a year, even just 1 day over a year, it becomes a long-term capital gain, and that tax rate is significantly lower.
How much lower?
Often 15% or 20% for most people, sometimes even 0% for lower income brackets. It's a massive difference.
So by trading frequently, by being active, you are voluntarily opting into a much higher tax bracket on your winnings. You are actively penalizing your own success.
You are giving away your edge to the tax man. But wait, it gets even better for the buy and hold investor. There is a second layer to this. It's called the deferral effect.
This is the real magic of compound interest, right?
Yeah, this is where the magic happens, yes. Remember, you only pay tax when you sell. The act of selling is what's called a taxable event.
Right.
So let's say you buy a stock at $100 and it goes up to $200. You have a $100 unrealized gain. If you don't sell, how much tax do you owe?
Zero.
Zero. That entire $200 stays in the market, working for you, compounding for you next year.
And if you do sell?
The moment you sell, you trigger the taxable event. Let's say you owe, I don't know, $30 in taxes on that gain. You pay it immediately. Now you only have $170 to reinvest for next year. You have permanently impaired your capital base. We call this tax drag. You are dragging a heavy anchor behind your financial boat.
So selling doesn't just risk missing a future market rally, it guarantees a bill from the tax man today.
Exactly. The buy and hold investor is essentially getting an interest-free loan from the government on their deferred taxes. You are keeping the government's money and using it to make more money for yourself, potentially for decades. It's the most powerful and most overlooked advantage they have.
When you put it that way, active trading feels like trying to run up a down escalator. You're working so incredibly hard just to stay in the same place.
That's a great analogy, and the math supports it time and time again. The friction of taxes and transaction fees is often more than enough to wipe out any alpha or extra profit a brilliant trader might generate.
Okay, so the math is clear. The theory is clear. The titans of the industry all agree. So why doesn't everyone just do this? Why is day trading still a thing? Why do we have entire cable news networks dedicated to what the market is doing right now?
Because we are human, and humans, it turns out, are just terrible investors. Our brains are hardwired for survival on the savannah, not for compounding interest on Wall Street.
We have some really specific data on this in the source notes from the Federal Reserve Bank of St. Louis, an economist named Yili Qian.
Yes, this study is absolutely fascinating and a little bit depressing. He looked at a phenomenon called return-chasing behavior.
Which sounds exactly like what it is.
It is. He analyzed the flows of money into and out of equity mutual funds over a long period, and he found a pattern that is almost tragic in its predictability.
Well, yeah, the pattern.
Investors tend to pour money into funds that have had high past returns, and they pull their money out of funds that have had low past returns.
Okay, I have to play devil's advocate here for a second.
Yeah.
That sounds logical on the surface. That horse is winning, so I'm going to bet on that horse.
Yeah.
If a fund manager is hot, I want to give him my money. Why is that a trap?
It's a trap because the stock market isn't a horse race. In a horse race, a fast horse is usually still fast tomorrow. In the stock market, we have a powerful force called mean reversion.
Mean reversion, that sounds ominous.
It just means that things tend to go back to the long-term average. If a fund just had a spectacular year and went up 50%, it is statistically very likely to cool off. It outperformed the average, so gravity is going to pull it back down toward that average.
And what about a fund that just had a terrible year and dropped 20%?
Well, it's statistically more likely to bounce back in the future. It's underperformed, it's likely undervalued, and it will probably revert back up toward the mean.
So by chasing the winner.
You are almost always buying at the peak. You are buying high after the great returns have already happened. And by selling the loser, the fund that is doing badly, you are selling at the bottom. You are locking in your loss right before the potential recovery.
The data had a specific number attached to this, a correlation coefficient. What was it again?
Right. Yelich calculated the correlation between fund flows, that's the money moving in, and the fund's past performance. The number was positive 0.49.
Okay, for the listener who isn't a statistician, translate what a 0.49 correlation means.
Sure. Correlation runs on a scale from an -1 to +1. 0 means there is absolutely no relationship. It's totally random. A plus 1 implies a perfect lockstep relationship. If A goes up, B always goes up by the same amount. So 0.49 is a moderately strong positive relationship.
And what does that prove?
It proves, mathematically, that investors are driving while looking exclusively in the rearview mirror.
And getting into a lot of wrecks because of it.
Yelichin's conclusion in the paper was brutal and direct. He said this behavior explicitly reduces profit. You are systematically doing the exact opposite of the golden rule of investing. Buy low, sell high. You are, as a group, buying high and selling low.
It's a behavioral tax. We are paying a tax for our own impatience and our own biases.
It's the cost of following your gut. Your gut says, get out, it's crashing, or get in, everyone is getting rich. And in finance, your gut is almost always wrong.
This leads us perfectly into the final boss of bad investing habits, market timing.
The ultimate vanity project for an investor.
The source defines market timing as selling a security with the specific goal of buying it again at a lower price. It's that fantasy we all have. I'll just get out before the crash, and then I'll buy back in at the absolute bottom.
And it is a complete fantasy. It assumes that you, sitting at your kitchen table, are smarter than the collective wisdom of millions of other professional and amateur investors all looking at the same information.
We've all heard the little sayings and adages, sell in May and go away.
The source mentions that one explicitly. They're called calendar effects. The idea that historically stocks have done poorly in the summer months, so you should sit it out and get back in around November. A buy and hold investor rejects this entirely.
Why? I mean, is the historical data wrong?
Sometimes the historical data shows these little patterns, sure, but they aren't consistent enough or strong enough to trade on, especially after you factor in the taxes and the transaction fees we just talked about.
Right.
But more importantly, the source references a specific study by Metcalf in the scientific journal PLOS-1.
PLOS-1 is a serious peer-reviewed journal. What was their verdict on market timing?
The verdict was clear. Market timing, on average, causes poor performance. The mathematics of timing usually work against the investor.
Why is the math against you? It feels so intuitive. If I sell before a 20% crash, I win. Right.
You only win if you get back in at the right time. That's the catch. You have to be right twice.
Explain that. That's a really good point.
It's not enough to know when to sell. Let's say you're a genius, or you just get incredibly lucky, and you sell everything right before a 10% market drop. You feel like a god. You're patting yourself on the back. You save 10%. But then the hard part begins when you get back in. The market starts to tick up a little bit. You think, oh, that's a dead cat bounce. It's a trick. It'll go lower.
Right. I'll wait for the real bottom.
Exactly. Then it goes up more. Now you think, okay, I'll just wait for a little pullback to get back in. Before you know it, the market hits a new all-time high. Now you are totally paralyzed. You have to buy back in at a higher price than you sold at. You lost money by trying to save money.
There are those famous studies, I don't think they were in this specific source, but they're everywhere, about what happens if you miss the market's best days.
Oh, absolutely. The source alludes to this massive risk. The vast majority of the market's long-term gains are often concentrated in a very, very few explosive trading days.
And if you miss them?
If you miss just the 10 best trading days over a 20-year period, your total returns often get cut in half, or even worse.
And those best days usually happen right in the middle of the worst chaos and volatility.
They do. The biggest up days often happen right after the biggest down days. So if you panic and sell on the scary down day, you are guaranteed to not be there for the massive recovery day that follows.
So if you try to dodge the raindrops, you end up missing the rainbow.
Cheesy, but surprisingly accurate. Buy and hold is, at its core, an admission of humility. It's an investor saying, I cannot predict the future. I cannot predict the next news cycle. I cannot time the market's emotional swings. So I will simply own the assets that benefit from the long-term growth of the economy.
Wow. We've covered a massive amount of ground today. We started with the paradox of speed, why doing nothing is often the hardest and smartest thing to do in a fast-paced world.
We define position trading. It's not laziness, it's confidence, despite volatility. It's the willingness to suffer short-term pain for long-term gain.
We looked at the strange bedfellows of Warren Buffett and Jack Bogle, and we realized that whether you think the market is perfect like the EMH people do or completely crazy like the value investors do, the practical answer is the same. Hold on.
We saw the brutal math on how taxes and fees eat active traders alive, that friction is the silent killer of wealth.
And we exposed our own worst enemy, our psychology. That 0.49 correlation coefficient from the St. Louis Fed showing how we are hardwired to chase yesterday's winners and lock in losses. It seems like buy and hold isn't just an investment strategy. It's more like a defense mechanism.
That's the perfect way to frame it. It protects you from the market, sure. It protects you from volatility, but mostly it protects you from yourself.
It protects you from your own destructive urge to tinker.
The urge to do something when the absolute best thing you can do is nothing.
Now, I want to leave the listener with one final thought that really stuck with me from the source notes. It's a bit of a brain teaser. The source mentioned that the most extreme advocates of the efficient market hypothesis say you should never sell unless you absolutely need the money.
Right. That is the ultimate logical conclusion of their theory. If everything is always perfectly priced, there's no reason to move.
So here's the question. If that's true, if the price is always fair, does the act of selling ever make sense from a purely investment standpoint? Or is selling purely a lifestyle decision?
That is a profound question. Because if the market is truly efficient, you never sell to take profits, because where would you put that money? Any other asset you buy is also, by definition, fairly priced, so there's no advantage.
And you'd never sell to cut your losses, because the current price is already the fair price reflecting all known information. Selling doesn't help.
Right. So the only logical reason to ever sell is because you need a sandwich.
Or a house.
Right.
Or to pay for retirement.
Okay.
It completely turns investing into a pure utility function. It takes the game and the ego out of it entirely. You aren't trying to score points. You're just trying to store value for when you need to spend it.
And maybe, just maybe, stopping treating your life savings like a game is the single best piece of financial advice there is.
I couldn't agree more. Sometimes the winning move is not to play.
Just stand there.
Thanks for diving deep with us. We'll see you next time.